Welcome back to Your Money, Your Way, your go-to source for in-depth financial analysis. Before we dive in, a quick but important reminder. This video is for informational purposes only and does not constitute financial advice. Always do your own research and consult with a professional before making any investment moves. Today, we are taking a comprehensive look at the first half 2025 financial results for one of Singapore's REIT giants, CapitaLand Ascendas REIT, or CLAR. We'll go beyond the headlines to see how each part of their global portfolio is performing and what their strategy looks like for the year ahead. Let's get started. All right, let's get straight into the numbers. For the first half of 2025, CLAR reported a stable distributable income of 331.1 million Singapore dollars. However, the distribution per unit, or DPU, saw a minor dip of 0.6% to 7.477 Singapore cents. Now, this was mainly due to an enlarged unit base from a recent private placement. Gross revenue came in at $754.8 million, a 2.0% decrease year-on-year. This was largely expected, driven by strategic divestments in Australia, Singapore, and the US. This was partially offset by a new acquisition in Indianapolis. Consequently, net property income decreased slightly by 0.9% to $523.4 million. But the headline numbers don't tell the whole story. Let's break down the performance across their key markets. In Singapore, which is their largest market, gross revenue was down just 0.4%. However, thanks to lower operating expenses, the net property income actually saw an increase of 2.3%. This shows strong operational efficiency in their home market. In Australia, there was a more noticeable decrease in net property income by 16.9%. The report attributes this to the divestment of 3 logistics properties in Brisbane and lower occupancies in certain assets. The United States portfolio, however, was a bright spot, with net property income growing by 2.2% thanks to the new acquisition of the DHL facility. Finally, the UK and Europe portfolio saw a 10% decrease in net property income, which the report notes is mainly due to lower occupancies and higher operating expenses at certain properties. Next, let's talk about portfolio health, which is crucial. Overall, portfolio occupancy stands at a healthy 91.8%. Let's look closer. In Singapore, occupancy dipped slightly to 91.2%, mainly because a single-tenant industrial property at 9 Serangoon North Avenue 5 became vacant. This highlights the impact a single large tenant can have. In the United States, occupancy declined to 87.3%. This was driven by a logistics property, Airworld 1 in Kansas City, becoming vacant. However, this was partially offset by a higher occupancy rate in their Portland business space portfolio, which shows active asset management at play. In Australia, saw a fantastic turnaround, with occupancy jumping by 3.9 percentage points to 93.1%. This was due to securing tenants for previously vacant logistics properties like 94 Lenore Drive and 16 Kangaroo Avenue in Sydney. Now let's talk about rental reversions, a true sign of portfolio strength. For the first half of 2025, CLAR achieved an average rental reversion of a very strong 9.5%. The U.S. portfolio was the star performer here, with an impressive 10.9% positive reversion, while Singapore also posted a solid 7.8%. A REIT's value isn't just about current numbers, it's about smart strategic moves for the future. And CLAR has been incredibly active. They've announced major acquisitions in Singapore worth over $724 million. This includes 9 Tai Seng Drive, a 6-story Tier 3 co-location data center, which is a fantastic addition in a high-demand sector. They also acquired 5 Science Park Drive, a premium business-based property with a BCA Green Mark Platinum certification strategically located at the gateway of Singapore's Science Park 1. On the divestment side, they sold the Parkside property in the US for a price that was a massive 45% premium to its valuation. This is a brilliant example of capital recycling, selling an asset at a high price to reinvest in higher growth opportunities. They're also not standing still on development. There are 6 projects worth nearly $500 million underway, including redevelopments at 27 IBP and Lodges Hub at Clementi in Singapore, and a new logistics center in Somerville, US. Of course, none of this growth is possible without a solid financial foundation. Let's look at their capital management. CLAR's aggregate leverage is at a healthy 37.4%, giving them a huge debt headroom of about $4.5 billion to fund future growth without stretching their balance sheet. Let's look at their debt maturity profile. It's very well spread, with the longest debt maturing way out in 2034. There are no major refinancing cliffs in any single year. For instance, in 2025, only $781 million, or 12% of their debt, is due for refinancing. This staggered approach provides significant financial stability. Impressively, green financing now accounts for 2.6 billion Singapore dollars, or 38% of their total borrowings, showing a strong commitment to sustainability. Another huge strength for CLAR is the power of their diversification. Beyond geography, their tenant base is a huge strength. Their portfolio serves over 1,790 tenants. The top industries are logistics and supply chain management at 12.8%, engineering at 12.3%, and biomedical sciences at 10.4%. This mix caters perfectly to modern economic trends. Their top 10 customers only account for about 14.9% of gross revenue. This includes major names like DSO National Laboratories, SEA Group, Stripe, and Singapore Telecommunications. Having no single tenant concentration makes their income stream incredibly resilient. So what's on the horizon? Let's look at the market outlook. The global economy is facing uncertainties, but CLAR is well positioned. The report notes that Singapore's GDP grew by 4.3% in the second quarter of 2025. In the US, the economy expanded at a 3.0% rate. While inflation remains a concern globally, central banks are taking measured approaches. CLAR's focus on developed markets with stable economic fundamentals provides a strong defensive posture. Finally, let's touch on something increasingly important for investors: ESG initiatives. CLAR has made significant strides. 49% of their portfolio is now green certified by gross floor area, with a target to have all existing properties green certified by 2030. They have 27 properties in Singapore installed with solar panels, making them one of the largest rooftop solar operators among Singapore REITs. This is projected to generate enough clean energy to power over 5,800 four-room public housing flats annually. This isn't just good for the planet, it's good for the bottom line. So, to wrap it all up, CapitaLand Ascendas REIT has delivered a stable and resilient performance. While facing some headwinds, their proactive acquisitions in growth sectors, strong capital management, excellent rental reversions, and deep commitment to ESG paint a very compelling picture. They are not just managing a portfolio, they are actively shaping it for the future. What do you think about CLAR's deep dive results? Drop your thoughts in the comments below, I'd love to hear them. If you found this analysis valuable, please hit that like button, subscribe, and ring the notification bell so you never miss another deep dive. Remember, this is not financial advice. Thank you for watching, and I'll see you in the next video.